And welcome to the 7th episode of the Year 8 blog, Equity Release Explained. I'm Ron Radway of Essex Equity Release Advice Centre, a specialist in the needs and concerns of those in later life, both financial and legal. Prospective clients can find themselves having to overcome negative preconceived opinions from their peers regarding equity release. I have to tell you, those opinions don't really stand up to inspection. So let's take a closer look at some of them. Number one, it's not safe. Well, all lifetime mortgages are sanctioned by the Equity Release Council, formerly Safe Home Income Plans, and to qualify must contain certain cornerstones: ability to move home, interest serving not mandatory, contrarily, ability to service the interest if desired, no negative equity guarantee, the interest rate fixed for life. All lenders are audited by the Prudential Lending Authority. All lenders and advisors are regulated and authorised by the Financial Conduct Authority. Number two, you no longer own your own home. Well, yes, you do. In exactly the same way as you own your own home with a conventional mortgage. Lender holds a legal charge of your property. You are responsible for ongoing maintenance and insurance. You can make alterations to the property. Other adults can reside, and you can move home. Number three. You can never move home. Oh, well, yes, you can. See the last Mythbuster. The mortgage can be ported as transferred to new property. It is subject to property suitability and some standard, non-standard constructions, and some leasehold conditions may be unsuitable. Number four, you still have to make the monthly payments. No, you don't, but you can if you want to. Once again, I'll take you back to Mythbuster number two. The mortgage is designed so that the servicing of the interest is not mandatory, and therefore you can never be evicted for non-payment. However, the interest will be rolled over. On the other hand, if desired and while affordable, either you or someone else can make regular or ad hoc payments that can be started, stopped, then resumed, which will mitigate the effects of compound interest on your estate. Number five, it will leave a debt for my children. No, it won't. See Mr. Mythbuster number two. All lifetime mortgages come with a no negative equity guarantee, which means that you will never owe more than your home is worth. Should that event occur, the worst scenario is that there will be no equity left in the property. And for that instance to happen, then a perfect storm is required. That the maximum loan is taken initially, that you live for a long time, and most importantly, house prices collapse. Clearly, this outcome is a possibility, hence the warnings, but not inevitable. And it must be said that if your house collapses in value, so does everyone else's, which basically means the end of the capitalist society as you know it. We'll be back to year zero. Number six, interest rates increase. No, they won't. Again, back to Mythbuster number two. All lifetime mortgages come with fixed interest rates, so future balances are known prior. What isn't known, of course, is life longevity and future house prices, which, if adverse, is where the no negative equity guarantee kicks in. Seven. It's too expensive. Well, to an extent, but no dearer than similar niche lending products. Interest rates are a little higher than conventional mortgages, but not extortionate, and setup costs are reasonable, considering the complexity of advice. Number eight, you will lose home upon entry into care home. For a single applicant, it would mean the mortgage has come to its natural end. Property will be sold, the mortgage redeemed. If a joint application, the mortgage will continue uninterrupted until the demise of the survivor. In either cases, a lender will allow 12 months to dispose of the property. Number nine, state benefits will be stopped. It has no effect on non-means tested benefits, like state pensions and health-based benefits, but can affect means tested benefits, pension credit, council tax benefit. This doesn't preclude taking out a lifetime mortgage. You just have to be careful how arranged so as not to exceed the benefit thresholds. Number 10, and the last one for this section, can't pay off early. As with all mortgages, clearing earlier than anticipated will result in a repayment charge. However, it can be redeemed early if desired. The charge is fixed, and runs between 4 to 15 years depending upon lender, and can be waived under certain circumstances of certain life events. But hopefully that will clarify and ease any concerns. And next up, we can look at the reasons, or some of the reasons anyway, why people take out equity release. Look forward to speaking to you again soon. Bye-bye.